You've been inside, and I wonder, Jim, just how fucked up is the Federal Reserve?
Well, it's extremely grossly incompetent. They literally don't know what they're doing, but it's worse than that, because you can be bad at what you do. You can be incompetent. But what's worse is if you don't know it. It's one thing if you're really bad at something, you're like, well, I'm not too good at this, I better be careful. But if you think you've got it and you don't know that you don't, then you're just going to commit one blunder after another. I think that's how I would describe the Fed. But yeah, I've had, one-on-one conversations with, Ben Bernanke and other governors, and, was partners with a couple of vice chairs, and I've had other conversations. Can't necessarily mention by name out of respect for the individuals, but ultimate insiders, I'll put it that way, real ones. And what they tell you privately is shocking. And one person said, but again, when I say person, this is somebody who practically sits, shares a desk with Jay Powell, but also the last two chairmen before that. And he said, the dots are a joke. He said, we wish we'd never started them. We can't get out of it now because the expectations are too high. Everyone, and what would CNBC talk about if they didn't have dots? But he said they're a joke. He said they're, because it's just a way to include non-voting members of the FOMC in the discussion. You get to put your dots up there. I said they're all guesses. And so when you average them, which is what they do on, financial TV, you're averaging a bunch of bad guesses. It's one thing if they were all kind of good at it and you take an average, that makes some sense. But if they're all bad at it, they have the worst forecasting record of any institution I can think of. So you got all these wild, crazy guesses with no foundation, usually wrong by orders of magnitude. And then you average them. I don't know what that is, but my point is, inside the Fed, they're regarded as a joke. So when you learn stuff like that, you're just like, okay, fine, I get it, but I've got better things to do. There are other much more powerful, much more meaningful indicators that you should spend your time trying to understand, rather than, I do read FOMC minutes, I have to admit it, but I don't get much out of them.
What about where we're at now, where they're getting worse at a faster rate? Like, we're getting to the point where the latest of late cycle indicators are worth what they're perceived to be making the next policy move on, but everyone knows they won't, because they'll blow up the world if they do it. And if they don't do it, they still have to be data dependent, which they say that they are, but they're late. What do you think about that?
I guess what concerns me when I look at risk factors, to me the biggest risk factor right now is the Fed actually will move. And of course, it will be at the worst possible time. So data that we can rely on, data that has a very long ability to predict markets in advance, not the stock market. The stock market, I want to say the stock market looks forward. It does look forward, but it always gets it wrong. The stock market did not see the 2020 crash coming. They did not see the 2008 crash coming. Did not see the 2000 dot-com crash coming. The stock market misses every major drawdown. Now, is there a market that gets it right? Yes, the bond market. When I say bond market, I mean the U.S. Treasury market, particularly the 10-year Treasury note. The 10-year Treasury note yield to maturity peaked in March at 1.745%. Today, it's down around 1.21. Give or take a basis point. That's a big drop. I mean,
Yep.
this audience understands that 50 basis points at that level, when you're at a low level to begin with, given the DV01, the dollar value of each basis point, that's like an earthquake. So what is the bond market telling you? It's telling you there's no inflation. They're worried about recession. I'm not forecasting a recession, but they're at least thinking about it. The economy's slowing. That's what the bond market is telling you loud and clear. Why on earth would the Fed be debating, well, is it time to taper or not? And then, and by the way, people say, well, tapering's not tightening because they're still buying some. No, I mean, if you're going 70 miles an hour in a car and you hit the brakes, the car doesn't stop immediately, it keeps going, but it's deaccelerating and you hit the brakes. So when you taper, you are tightening. Because yes, you're buying. In the dynamic system, everything happens at the margin, okay? So you don't have to go to zero taper and then raise rates before you're tightening. When you taper a little bit, you're tightening. Maybe it's slowly, maybe it's gradually, maybe it's signaling. But why are they tightening when the bond market is telling you loud and clear that the economy is slowing, which it is, and there are many, many other indicators. Just not to paint with too broad a brush, I don't have a lot of confidence in anything coming out of the Board of Governors in Washington, but there are these little pockets of the Fed that get some things right. The Atlanta Fed GDP nowcast is pretty good. It's not perfect. It misses sometimes, but it actually gets the direction right. Now you go back to April and look at the the second quarter forecast, and now, of course, we're well into the third quarter. That number has gone from 13% to 11%, 10%. They were 7.5% the day second quarter GDP came out. The GDP printed at 6.5. Now they're at 5.1 for the third quarter. Well, first of all, that tells you right there that the economy is slowing enormously, but it's worse than that because a lot of people don't understand how Atlanta does that. Wall Street there's a whole bunch of data that goes into GDP. They have some, they don't have others. So they do estimates of the others and they get those wrong, but that's their forecast. What Atlanta does is they say, well, what would it be if we just had the data we have now? In other words, we're not going to guess at the blanks. We know there are blanks. This is going to be updated, so it's a little more Bayesian in that sense. But what would it be just based on what we know now? And then they update it, and that's what a good Bayesian technique does. Well, if you're at 5.1%, here we are, two-thirds of the third quarter is done, right? Well, if you're at 5.1% and you started at 7.5%, that means it's even worse today because 5.1% is the annualized expected average for the third quarter, okay? But you got to be worse than that today in order for that to be the average, considering you started at 7.5. So again, it's worse than 5.1. That's just their estimated average, but it's worse than that now. So, and the San Francisco Fed has done some good research on the impact of COVID. We can talk about that, the pandemic, if you like. But so yeah, there's little pockets, but you got to hunt for them because the stuff coming out of Washington is just nonsense.
And
right.
By the second quarter of next year, the growth rates of both growth and inflation are going to collapse. So bond market's pretty good at looking ahead 12, maybe let's say 3 to 6 months ahead at least, maybe 12. And my question is, in the meantime, as you well know, there's sticky stagflation that's late cycle there. So I'm positioned for stagflation, but then I'll go from stagflation to deflation. You're like, longer term, this is basically the Jim Rickards deflation case, is that you can have cyclical inflations, but you're going to come back to the deflation. What is the chance that you get a 1970s style stagflation that actually sticks though? And I'm wrong on that, and we don't get the deflation.
Yeah, I think you'll see the stagnation, which I would describe as the economy slowing. I think That's very clear. There's tons of data on that. And part of it's the Delta variant, but I wouldn't, that's a serious disease and it's fatal in some cases. Part of it's Delta, but I wouldn't chalk it all up to Delta. There's plenty of evidence that the economy is slowing for a lot of other reasons. Savings rates are high. What they call precautionary savings, saving for a rainy day, if you want to put it that way. Over the past year and a half, they've been at historically high levels. It's come down a little bit, but it's still way above average. There's a reason for that. This whole thing of a labor shortage, there is no labor shortage. Now, it is true. You go to a restaurant and the first thing the waiter comes up and apologizes and say, look, it's going to take an hour to get your entree because we're short of help in the kitchen. And you see that, every retail place you go to, and you see that everywhere. So people have interpreted that as a labor shortage, implying inflation's right around the corner. It's not. The problem is that you don't have enough applicants, that you've got a pool of maybe 15 million, the number is not clear, but look at declining labor force participation, number of people getting unemployment benefits, extended unemployment, et cetera. You've got a pool of 15 million prime age workers. I'm talking 25 to 54, not 65-year-olds. You can work when you're 65, that's fine, but I'm talking about that prime demographic who are not working. Now, they're not counted as unemployed because they're not looking for jobs. Why not? Well, because they're getting government benefits left and right, and meanwhile the employers want help, but they can't pay the clearing wage. Meaning, you could get the help if you pay enough money, but they can't because they'll go broke because their volumes are down. So this so-called labor shortage isn't really a labor shortage. It's much more disinflationary, which is the inability of employers to pay a clearing wage and the unwillingness of workers to come back into the workforce because the government's handing them all kinds of checks. So that's very, very different than a true labor shortage. And it's not inflationary because when they do come back, when the unemployment benefits run out, I think this week, they've been going out gradually state by state, but the last few states are all going to, basically September 1st, it all goes away. And that'll bring more people back to the workforce. And then you're going to see the unemployment rate go up because you're expanding the denominator, not expanding the numerator necessarily. So there isn't really a labor shortage. There's an inability to get people at a wage you can afford to pay. That's a much more disinflationary, depressionary statistic. I mean, there's a lot of others. I mean, we talk about people aware of base effects. The base effects are about to run off. Because the Fed looks at core PCE year over year. I think there are 15 different measures of inflation, but that's the one they look at. So if you want to front run the Fed, you got to look at it yourself because it's telling them what to do. Well, year over year. So April, May, June, even July were hot. Okay, but where were we in April, May, June, July 2020? Mm-hmm. The worst economic collapse since 1946, and in some ways going back to the Great Depression. So, and prices were dropping, and the economy was shut down at least for a couple of months. So, how much of that accounts for the inflation numbers we saw? Well, it's hard to know because base effects are rare. Actually, they're not usually that big. So it's a little bit hard to untangle. But the best estimates I've seen are about half. So those 5-6% numbers were really, 2.5, 3, which is not too far from where we've been for the 11 years from 2009 to 2020, which is around 1.8, 1.9, and we're going to fall back to that very quickly. So I just don't see the inflation. That's what the bond market's saying. That's what the labor market is saying. The government handouts are about to run off. So we saw some good growth in retail sales earlier this year. Well, sure. I mean, in December, the last days of the Trump administration, they handed out, I believe it was a $600 check. And then Biden comes in, and in February they handed out, I think it was a $1,400, maybe $1,600 check. So yeah, you get those checks, and people spend it, some of it anyway, and that's a boost to retail sales. That's over. There's nothing, even in Nancy Pelosi's $3.5 trillion spending extravaganza, there's no provision there for another round of checks. So you start to pull that kind of support away, you start to take the base effects away, you look at the slowing metrics we talked about, you're back down to that, maybe 2.2% growth, maybe lower, and 1.6% core inflation. Every year the Fed does a 1-year forward forecast, do it every year. So 2009, they forecast 2010, 2010, they forecast 2011, et cetera. Look at that time series, that annual 1-year forward forecast. They're wrong every time by orders of magnitude, meaning, going back to the last recovery, 2009, 2010, they'd say 3.3 and it would come out 2.1. If they said 3.3 and it came out 3.1, I would say, hey, nice going. You stuck the landing. That's really, really close. But they're off by like a full percentage point, which is in a world that only goes between -4 and +4, pretty much. You're off by a full point. That's an order of magnitude, and they have been. So why would we listen to anything they say? Well, so the way it's set up right now, there's a Fed meeting in September, and the one after that is November. And looking at the last FOMC meeting, they dropped as many hints as they could. They sprinkled them all over the place because they don't want to surprise anybody, that they're going to start to taper in November. And again, you'll have your Wall Street economists saying, well, that's not tightening. Yes, it is, for the reason I mentioned. So they're going to start tightening in November. Now, what Jay Powell, if he has one thing going for him, is the fact that he's not an economist, he's a lawyer. And it doesn't mean he understands monetary economics, what we're talking about, but lawyers do tend to be a little bit pragmatic. So maybe he'll get it, but I can't count on that. They've said basically they're going to start the taper in November. They're going to probably cut treasuries and mortgages at the same tempo. One's more than the other, but they're kind of scaling back. They'll do it at every meeting, maybe 10% of the total per meeting for the next 8 meetings, et cetera. It's just playing the tape in reverse. They go, first they cut rates to 0, then they do QE, and then when they have to reverse it, they do the quantitative tightening or the tapering first, and then they do the rate hike. So they play the movie in reverse. They're probably going to start that in November. I don't think, I'm not sure, that the data by November is going to convince them otherwise. It will be the worst possible move at the worst possible time. And Powell's enough of a pragmatist. And by the way, he got really badly burned in 2018. Between October 1st and the Christmas Eve massacre in 2018, the stock market dropped almost 20% because they had over tightened, and there was a little liquidity crisis behind the curtain in mid-September. So he learned his lesson there, hopefully. But it looks like they're going to fly right into that buzzsaw once again. And so that's what concerns me, is that the economy is weakening. The bond market is telling us that. There are other indicators telling us that. but they're not looking at that. They're looking at the unemployment rate, which doesn't mean anything because of labor force participation, and they're going to actually start to taper in November, which is what I would expect right now, and that's going to be the worst possible move.